Hello everyone, welcome to chapter 7 of the Access Cycle. Before we actually get into the chapter and the content of the chapter, let me first of all talk about the objective of it. Now, first of all, this chapter is going to be a quick one, and that's not because it's unimportant or insignificant, but because everything inside this chapter is just simply a summary of what we've already covered in the previous chapters. Okay, up until now, I've given you every piece individually. Okay, now I'm just showing you how these pieces fit together into a single repeatable process. Okay, this chapter basically will give you the complete top-down framework that ties everything together that we've studied so far, whether it's bias, context, or execution. And by the end of this chapter, you'll know exactly how to first of all build a directional bias across multiple time frames, number two, how to create a proper market context, and number three, how to execute properly. Okay, now, none of this stuff that I'll be discussing is new. You've already seen every component before. You've studied it in the earlier chapters. You may have even practiced it. But in this chapter here, I'm just putting all of them together to give you a full top-down framework and a complete top-down framework that you can actually use every single day to analyze the market in a consistent, a repeatable, and what's the right word? And an efficient manner, in an efficient way. Okay, now let's get into the chapter. So first of all, let's quickly talk about time frames. Now, right here, these are the only time frames that I personally use. And obviously each one of them serves and have a specific and non-negotiable role inside the access framework. Okay, first of all, we've got the directional time frames, which are the monthly, the weekly, and the daily time frames. And these are the time frames that I use to build a higher time frame directional bias. And then we've got the contextual time frame, which is the 4-hour time frame. And this time frame is basically used to build or establish or identify a market context, a proper market context. This time frame basically acts is the bridge between bias and execution. Okay, now this time frame is also used to evaluate, or you could say assess or check market conditions to determine whether it's worth trading today or not. Okay, after that we've got the execution time frame, which is the 15-minute, and this is where I actually execute and find my entry setups or my entry model. So yeah, these are the time frames. Now each time frame has its role, and I obviously don't mix them up. Now let me break down how this entire framework is structured, because once you understand the layers and how they are structured, everything else will start to make sense for you. Now obviously this framework is built in layers. Okay, it's built in a step-by-step manner with proper steps, okay, from higher time frames all the way down to execution in the 15-minute time frame. And the most important thing is that you never skip a step. Okay, before anything else, obviously we first start with the first layer, which is the directional bias layer. And before anything else, your job is to figure out which direction you expect price to expand, which means that you don't look for key levels on the intermediate time frames, or you don't look for entries and any of those things until you've done this first step, until you've established a directional bias. And if you do the opposite, if you skip this layer and go straight to looking for setups or establishing a context, then your whole trade idea becomes baseless. Okay, so the first step is always to start with directional bias, and once you've established it, then you can move on to the other layers. And the same thing with the context layer and the execution layer. You don't move to the execution layer or the 15-minute time frame until and unless you've established a proper market context on the intermediate time frame, which means uh, identifying appropriate key levels and candle ranges. Okay, now first of all, let me walk you through the first part of the framework, which is the directional bias layer. Now you know that we've already gone through these layers in detail in the previous chapters, chapter 2 and 3, and I've already discussed the procedural frameworks for these steps as well in those chapters. So if you want to study them, go watch those chapters. But in this chapter, I'm just putting all of those different pieces together, so it's not all over the place, and you can get the whole playbook or the complete framework in just a single chapter right here. Okay, that's the whole point of this chapter. And with that being said, obviously everything starts within this layer. Your whole trade idea begins within this layer. And we break this layer into three parts: structure, narrative, and refinement. Step one is structure, and we begin on the monthly time frame. We start our analysis on the monthly time frame, and this is where we basically determine a macro directional context, or we look at the macro context. Okay, we look at stuff like seasonal tendencies and quarterly shift, and with the help of those concepts we determine a macro directional context. Okay, after that we then apply the principles of market structure on the monthly time frame, and we determine whether the market is moving higher or it is moving lower. Okay, and once we've done that, then we refine it further using market profiles to get a sense of whether which cycle or profile the market is moving in. And all of this is just to generate a directional idea. Okay, the goal here in this step is to form a directional idea. And then we move into the second step, and in this step we go a bit deeper. We first of all identify the current and the relevant dealing range, and then mark out key levels within it, appropriate key levels within it. And then using those key levels, we define both short-term and long-term drawn liquidity. Okay, and this is the part where your directional idea turns into a directional bias. And after that we then move on to step 3, and within step 3 we just basically refine our analysis across multiple time frames from the monthly down to the daily time frame. Okay, within this step, step 3, this is where we refine everything. Okay, we've already formed a directional bias on the monthly time frame, but now we need to get specific, meaning we need to now determine what's the actual bias for today, what's the actual directional bias for the current trading day that we're going to trade. And that is exactly what this step is for. And within this step we repeat the exact same process both on the weekly and the daily time frame, and at the end of that process we get a precise bias, a precise directional bias for the current trading day. And the reason this step matters, and the reason why this step is so important, is because, for example, you could be bullish on the monthly time frame and bullish on the weekly time frame, but when you look at the daily time frame, you could still have scenarios or cases where you could have a short-term bearish drawn liquidity or a short-term bearish directional bias. And if in those scenarios you had missed this step, then you could have incorrectly, invalidly forced a bullish directional bias on a bearish day. Okay, and that's something obviously you want to avoid. And this is why we have this step where we refine our analysis from the monthly down to the daily time frame and make our directional bias even more precise to our current, relative to our current trading day. That is all this step is for. We just repeat the same process to have a much tighter focus from the macro down to the micro. Now let me actually walk you through a live example of me applying this entire process step by step on this EURUSD chart. Now I want to show you exactly how to approach the framework or the directional bias framework correctly. Okay, how to actually use it to build a macro directional bias on the monthly time frame and then refine it down to the daily time frame to have a micro directional bias for the current trading day. Okay, so first thing first, we're going to start off with the monthly time frame. Now like I said before, the first step is to look at quarterly shifts and seasonal tendencies. Okay, use those concepts to basically establish a macro directional context. Okay, that is the first step. So when I look at these monthly candles, here is what I see. You can see that from October to January, these 4 months we had bearish price action. Okay, we consistently formed bearish price action, which means that the last quarter was clearly bearish. Now, after that, the February candle printed bullish. It had bullish price action and it closed higher. Now, what this tells me, what this sequence tells me, is that the last quarter was bearish, and last month we just had a shift in that quarterly price action and we shifted bullish. Okay, we had a bullish quarterly shift, and now March and the month of March could potentially be expected to have bullish price action, and obviously only if the other concepts support this idea. Okay, so based on quarterly shifts, the macro directional context is that the month of March could potentially be expected to have bullish price action. Now the next step is to look at the seasonal chart for EU and check the seasonal tendency for the month of March and see whether we can have bullish or bearish price action. And based on the seasonal chart, based on the 20-year seasonal chart, I can see that the month of March has had bullish to slightly ranging price action. Okay, based on the seasonal chart, I can see that historically, on average, for the past 20 years, EU has had bullish to slightly ranging price action for the month of March. So now we've got two things pointing in the same direction. We first of all got quarterly price action implying that this quarter or this month, this current trading month, could be bullish. And along with that, we have the seasonal chart and seasonal tendencies also telling us that the month of March can potentially have bullish to slightly ranging price action. Okay, so these two things, these two concepts are pointing towards the bullish direction. And that gives us a bullish macro directional context or a bullish directional hypothesis for the monthly time frame. Okay, but obviously that's not enough. Okay, that isn't a valid directional bias. That isn't even a structural idea. It's just the starting hypothesis. Now what we need to do is either validate or invalidate, or you could say support or reject this idea, this hypothesis, with the help of the other concepts, with the help of the other steps. Okay, this directional hypothesis alone isn't enough. Now we need to either confirm it or invalidate it. Okay, so that brings us to our next step, which is to use the principles of market structure to first of all build a structural idea and then refine that idea with the help of market profiles. Okay, now looking at this price action right here, you can see that from this point on, from this origin point, we've had a bullish expansion higher. Okay, we've had a bullish expansion higher, and then we formed ranging price action in a slightly bullish fashion. Okay, within this price action, we rejected below lows and broke above highs consistently. And what this tells me is that the structure is bullish and it is leaning bullish. Okay, so now based on structure, I've determined that the structure is bullish. Okay, it is bullish. And now I have to use market profiles to refine this idea even more. And when I do that, here is what I see. I can see that we've had an SMT divergence with GU right here. Okay, at this point, based on the bullish structure, you would have expected price to continue this price action higher until we had taken out this high. But before we took out this high, we had an SMT divergence with GU right here, which basically confirmed this macro dealing range for us. Okay, because of this SMT divergence and because of this candle closing lower and having this structural shift or this CSD, from this point on, you would have then marked out this new dealing range. Okay, and based on market profiles, you would have confirmed that now this expansion has ended, and this micro expansion has also led to this formation of this new dealing range along with this SMT divergence. And now the next thing that you could expect price to do is to have a bearish retracement lower so that we could rebalance this dealing range and test a discount key level before expanding higher even further. Okay, so even though the structural idea was bullish for this price action, throughout these 4 months, you would have expected bearish price action because of the formation of this new dealing range that was formed as a result of this SMT divergence with GU and this candle closing lower. Okay, because of these two factors, we had short-term drawn liquidity, and this is why I always emphasize that bias is more important than the raw structure. Okay, bias is more important and market profiles are more important than just raw structure. Okay, you could have looked at this bullish structure and blindly chased bias, but because we used market profiles and because we refined that idea, we now have a deeper narrative. Okay, so the structure is bullish, but the market profiles is telling us that we could have a bearish retracement. Which brings us to our next step, which is building a narrative and establishing a directional bias from this structural idea. So now, obviously, the way we build a narrative or we establish a directional bias from this structural idea is that we use dealing ranges and key levels. Now we've already identified the dealing range, which is this expansion swing. Okay, this is our macro dealing range, this is the premium region, and this is the discount region. The second step is to now identify appropriate key levels within the dealing range, and the discount key level we have within this dealing range is this order block right here. And right here you can see that the last 3 to 4 months, or from January or from October to January, EU has had bearish price action so that it could rebalance the dealing range and reach this discount key level. Okay, and now that the dealing range has been rebalanced and the discount key level has been tested and there is no short-term drawn liquidity, that means that now EU is perfectly positioned for a bullish expansion higher from this discount order block. Okay, we've rebalanced the dealing range, we've reached the origin, which is the discount key level in the form of this order block. And now that we've had this bullish reaction on February, for the month of March, our directional bias is bullish. Okay, we changed our directional idea into a bullish directional bias for the month of March. And now the next step is to refine this monthly directional bias down to the daily time frame and establish a much more precise directional bias for the current trading day and the current trading week. Now let's refine that monthly directional bias to a weekly directional bias on this weekly time frame. So first of all, right here, you can see that this is the monthly order block, the monthly discount key level. And you can see that for the past few months, we've had this bearish retracement lower. And with this bearish retracement, we rebalanced the macro dealing range on the monthly. And also we reached the discount key level. Now let's zoom in. So you can see that after reaching the discount key level and testing the discount key level, we then had this reaction higher. And with this reaction higher, what we did is that we had a structural shift, or you could say a change in the state of delivery. Okay, with these two candles, we engulfed and closed above these two consecutive candles, and we had a change in the state of delivery, which led to the formation of this new order block. Okay, on the monthly time frame, our directional bias for the month of March was bullish. Okay, and now on the weekly time frame, we can see that we've now had a change in the state of delivery, which also validates that monthly bias and confirms that idea. And along with that, it also gave us this another discount key level and this new key level in the form of this order block. And now we can expect price to have a reaction off of it. Okay, we can expect price to have an expansion off of it. Okay, after forming this order block and having this change in the state of delivery during the month of February, we tested this order block and had a deep reaction to it. Price had a deep reaction lower, and then it closed higher and had a reaction to it. Now, last week you can see that we had a purge below this weekly candle low, and all of this is happening inside this discount order block, this significant order block. So now the next week we can expect price to form or have a bullish weekly candle. Okay, the next week our directional bias based on this structure and based on this transaction is going to be bullish. Okay, so basically we refined our monthly directional bias down to a weekly directional bias. Okay, based on this weekly time frame price action, based on this structural change, this structural shift, and the formation of this new key level, this new order block, we've established a new weekly directional bias which is also bullish. Okay, so for the next week we're going to expect price to have a bullish expansion off of this key level. But again, that is still not enough. We now have to move down to the daily time frame and refine this weekly directional bias into a daily directional bias for the current trading day. Okay, so now I'm going to refine that weekly directional bias down to a precise daily directional bias for the current trading day, which is going to be Monday for us. Okay, first of all, I'm going to use the principles of market structure to build a structural idea, and then I'll use dealing ranges and key levels to build a narrative and establish a directional bias, a precise directional bias for Monday and the next week. Okay, so now obviously the monthly and the weekly directional bias is bullish, but now I'll repeat the exact same process and build and establish a new directional bias for the current trading day, which is obviously Monday. So first of all, using market structure, I can see that after rejecting below this low, and testing the higher time frame discount key level, we then had this expansion higher, and with this expansion higher, we had a structural shift and we broke above this high. And then from this point on, we then shifted to a bullish structure and started having bullish structure in the form of price rejecting below lows and breaking above highs. Okay, and when price rejects below lows and break above highs, that is what we call a bullish structure. So based on structure, we've determined that this structure is bullish, the structural idea is bullish. And also using market profiles, we can see that after having this expansion higher, we then had this retracement lower. So now the next step of the process is to build a narrative, which means identifying the most appropriate and the most relevant dealing range within this price action, and then identifying key levels within that dealing range, and then based on that determine and figure out whether this retracement profile has been completed or not, whether we have any short-term down liquidity or not, and whether we can have an expansion straight away from here. Okay, those are the things or the scenarios that we will determine by building a proper narrative, which involves identifying a dealing range. And then based on that dealing range, we can have multiple scenarios. The first scenario is that we have a short-term drawn liquidity. Okay, we have a short-term drawn liquidity. Let's say this is our short-term drawn liquidity. Now that's not the case here, but let's say I had determined that this is our short-term drawn liquidity. Then in that case, on Monday, my directional buys would have been bearish. Okay, on Monday and for the next week, my directional bias would have been bearish until we had filled this short-term drawn liquidity and taken out this low before having an expansion higher. And the second scenario that we could have based on the dealing range and the key levels that we identify is that we can have an expansion straight away from here and we don't have any short-term drawn liquidity. Now it's up to us to determine which one of these scenarios is true. Okay, so first of all, I'll identify the most appropriate and the most relevant dealing range. Now in this price action, if I zoom in, now obviously I need a significant high and a significant low for a dealing range, right? So this is the most recent expansion swing that we have, and the significant high within this expansion swing is obviously this high. And the reason this high is significant is because this high led to this low being broken. Because of this high, this low got broken. So this is a significant high. Now we need a significant low. Now within this recent expansion swing, the first significant low we have, the most appropriate significant low we have is this low. Now the reason this low is a significant low is because this low led to this opening gap being filled. This low filled liquidity inside this opening gap and reacted to it. And for that reason, this low is a significant low. So this becomes our dealing range. Okay, this becomes our dealing range, and now within this dealing range, this is our appropriate in the our current dealing range. Now within this dealing range, first of all, we have this discount key level in the form of this low, and along with that, we also have this discount order block. Now the reason this candle is an order block is because this candle also filled liquidity inside this opening gap. It reacted to this key level, filled liquidity inside this opening gap, and then price engulfed it in the form of closing above it. And for that reason, for those two factors, this is also a discount key level. And right here, based on this structure, based on this framework, we can see that we've successfully rebalanced the dealing range, and along with that, we've also tested a discount key level. So our expectation based on this structure, based on this narrative that we've built, our expectation for Monday would be that Monday is going to have a bullish range expansion higher. Okay, Monday is going to have a bullish range expansion higher, and our bias is going to be, our directional bias for Monday is going to be bullish. Now let's just imagine for a moment that we don't have this bearish price action. We haven't yet rebalanced this dealing range. Let's imagine this. And on Friday, price closed right here without this bearish price action. Then in that case, our directional bias on Monday would have been bearish, and we would have expected Monday to continue this bearish retracement lower until we had successfully rebalanced the dealing range. But since that's not the case here, and price has already rebalanced the dealing range on Friday past week, the previous week, for that particular reason, our directional bias here on Monday is going to be bullish. Okay, it's all about how price is structured inside the dealing range. Now let's get back to the slides and let's go over the next few days, and let me explain those slides to you. And then I'll get back to this example again and actually show you how I continued this top-down analysis, and then how I built a proper market context on the 4-hour, and then I'll show you exactly how I framed my trades on Monday and the next few days. Okay. Okay, so in the example, you just saw how we determined our directional bias starting from the monthly time frame, and then refining it down to the weekly time frame, and then finally narrowing it down to a precise daily directional bias for the exact trading day. Okay, Now we move on to layer 2, which is the contextual layer, or you could say the context layer. Now this is the layer that tells you if today is even worth trading or not. And if the answer is yes, then it tells you what kind of context you will be trading in. Okay, this is basically where your directional bias for the day meets real market conditions. Okay, and here is exactly what you do in this layer. First of all, step one is exception protocol check, or you could say checking your exception protocols. Now I accidentally wrote down execution here, but it's actually exception. Okay, exception protocol check, meaning checking your exception protocol and seeing whether the market conditions for today are high probability or not. Okay, you're going to ask yourself whether today's market conditions are favorable or not. Okay, now if you're wondering what are exception protocols, then you should watch chapter 4. In that chapter I explained everything about exception protocols, and basically they are protocols which tell you that even if you have the correct directional bias for the day and you've accurately determined it, and you also have a proper market context on the 4 hour, there could still be certain trading days in certain instances where it wouldn't be high probability for you to trade, meaning that even on those days, on those type of days where you have both the directional bias and context aligned with each other and you've accurately determined it, there could be some factors which could lead to those market conditions being unfavorable for you or low probability for you, and in those instances you should avoid trading. Okay, now an example of an exception protocol would be the 4 days protocol, which says that if the last 4 days price has had bearish consecutive bearish price action, meaning that if the last 4 daily candles were all bearish, then in that case, even if your directional bias for the 5th day is bearish, it is highly unlikely for price to continue moving lower on the 5th day. Okay, that is an example of an exception protocol. And in that case, on the 5th day, even if everything is perfectly aligned with each other in the bearish direction, you will still avoid trading on that day, because just like I said, the market conditions on that day in the bearish direction would be unfavorable for you, or they would be low probability for you to trade. Okay, that is an example of an exception protocol. Now, if you're wondering who came up with these protocols, then obviously I have answered this before, and the answer to that is ICT himself. Okay, so you can study that even on ICT's channel. Now, again, you need to remember that none of this stuff that I'm talking about, or that I'm teaching you, or that anyone else is teaching you, or ICT is teaching you, or Romeo is teaching you, none of this stuff is going to be 100% right. None of this stuff is going to be perfect. None of this stuff is 100% accurate. Okay, there are still going to be a lot of trading days, or a lot of examples, or a lot of instances where this stuff wouldn't work and the market will go completely against it. Okay, there are still going to be those type of days, and that's completely fine. There is absolutely nothing wrong with that. Okay, none of this stuff is going to be perfect, and that's okay, because that's what trading is all about. Okay, it's not about being perfect, it's about having a proper edge with a positive expectancy, and then the rest is your competency to be able to consistently execute that edge day in, day out, every single day, every single week, every single month, for a whole fucking year, without messing up, without making any inconsistencies, without making any mistakes, without making any errors. Okay? So Again, even with this concept, with these exception protocols, there are going to be days, there are going to be certain instances where the market wouldn't follow this exception protocol, like the 4-day exception protocol, and will actually form consecutive price action even on the fifth day. Now, before you send me those examples, those rare examples, you need to listen to this. Okay, so that was basically your first step, which is basically checking the exception protocols and determining whether the market conditions for today are right or not, or whether the market conditions are high probability or not. Okay, and once you've gotten the green light, and once you've confirmed that the market conditions are favorable and the market conditions are high probability, then you move on to the step 2, which is where you determine a proper market context or establish a market context. Okay, the first thing that you will be doing is on the 4 hour, on the intermediate time frame, you will be identifying the most relevant dealing range. Now, this is different from the dealing range that we identified earlier on the daily time frame. Okay, because that one was just to establish a directional bias. Okay, the dealing range that we identified on the daily time frame, we were using that to establish a directional bias. Okay, we were using that to differentiate between short-term and long-term drawn liquidity, and then using that we were able to establish a directional bias. But this one, this dealing range that we're going to identify on the 4 hour, we will be using this for a market context that we will use for framing trades. Okay, this one right here will be used for framing trades on the 15-minute time frame. Okay, so what you do in this second step is that you mark out the current 4 hour dealing range, you spot the key levels inside that dealing range, respective key levels inside that dealing range, and then you identify where price is most likely to expand from, meaning obviously it's going to expand from the discount key level or a premium key level depending upon the context. Okay, so once you've identified that, you then finally mark out the area on your chart and you set your alerts there. Okay, you set an alarm at those key levels, and then you basically wait for your entry triggers. Okay, after doing that, your job is basically done for the second layer, or in this second layer. From that point forward, from that point on, you then move into the final layer of the framework, which is the execution layer. Okay, that was the second layer. Now let's move on to the third layer, which is the execution layer. Now this layer is where your discipline, your patience, your emotional intelligence, your emotional competence, and your trading psychology gets tested. Okay, this is where a lot of people fuck up, and if you don't have the right mindset, the right trading psychology, and enough emotional competence or enough emotional intelligence, then that could lead to a lot of mistakes, a lot of errors, and a lot of inconsistencies. Okay, now let me show you exactly how it gets tested. So first of all, the first step here in execution layer that we have is entry triggers. Okay, now entry triggers, I've already explained this before, but I'm just gonna quickly go over it. Now within the entry triggers, you are not actively trading. Okay, you're just waiting for your entry trigger in the form of maybe a candle range purge, or a key level reaction, or an SMT divergence. Okay, so in this stage, in step 1, sorry, your job is to sit on your hands and just wait patiently until one of these entry triggers appear or happen or form. Okay, and this is where a lot of people screw up. This is where a lot of people mess up. What happens is that they start getting impatient, and because of that, they start forcing trades. They begin justifying random invalid key levels or random candles as key levels, or they start justifying made up CRT or candle ranges. Okay, and that leads to those people taking losses that they never needed to take in the first place. And the only thing that they had to do is just to wait for their entry trigger. Okay? So your first step is to wait for the correct entry trigger. And until then, you just stay on your hands, stay patient, and do nothing. Okay? Your first test of your emotional intelligence and your patience happens right here. Once the entry trigger has formed and it has occurred, then you move on to step 2, which is entry confirmation. Okay, in this step, you patiently wait for your entry setup, your entry model, or your entry pattern to be formed and confirmed at a key time. Okay, now this step is also where your patience and your discipline and your emotional intelligence gets tested. Okay, now what some people do in this phase or this step is that instead of waiting for their entry to be confirmed in the form of maybe an order block forming or a fair value gap forming at a key time, they start to think and start telling themselves that what if I miss this move, what if this move flies without me, or what if I miss this expansion, and what if I don't participate in this move higher or lower. And that's obviously FOMO talking, right? And because of this FOMO talking, because of this second guessing, they throw everything out the window. And then instead of actually waiting for the entry to be confirmed at a key time, they just start hallucinating. They start seeing random images on the charts. And instead of waiting for the entry or their entry pattern or the entry model, because of the fear of missing out, they enter early. Okay, and the correct approach, obviously, I don't have to tell you, is that you need to wait for your entry confirmation, your entry model, your entry setup, your entry pattern. And once it's confirmed, you then validate that entry model by confirming that it formed or it occurred at a key time. Okay, and then after that, you move on to step 3, which is the execution part, where you execute or basically take your trade, your entry, your setup, or your model. Okay, now this is also where your emotional intelligence and your discipline gets tested. And the reason for that is that once you've actually executed the trade and you are inside the trade, your job is to just let the trade play out. Okay, your job is to just wait patiently and wait for price to either hit the stop loss or reach the target. Okay, that's the only objective you have in that instance, or after you've executed your trade. But what some people do, what most people actually end up doing, is that instead of waiting patiently and letting the trade play out, they start obsessing over the PNL. Okay, they keep looking at their PNL, and because of that, they watch every little movement, they watch every little tick. Okay, they watch every single 1 minute candle, and every candle ignites their emotion. Every single candle, every single little move influences their emotions. Okay, and because of that, they overmanage. Okay, they start micromanaging their trades. They start second guessing their decisions. They start second guessing their whole fucking system. They start second guessing their stop loss. They start moving their target to random places on the charts, random imaginary levels on the charts, thinking that that is where price is going to stop. And if they don't move their target there, they're going to miss out on profits. Okay, they start doing all of these random, ridiculous, dumb, crazy shenanigans. Okay, so this is why I said earlier that this is where your patience gets tested. Okay, this entire layer is is basically a test of your patience, your control, your emotional intelligence, your emotional competency. Okay, so you need to be extremely well minded, and you must have a strong mindset when dealing with this layer. Okay, so this is the execution layer, the final layer of the access framework. And this is where you end your top-down analysis. Okay. Now let's get back to the earlier chart examples, and let me continue that whole top-down analysis with these new layers, and let me show you how you could have taken trades in those instances, and let me show you the exact trades that I executed in those examples. Okay, so we went through the first layer, the directional bias layer, and within that layer we determined that our directional bias for Monday is bullish, with the drawn liquidity being higher. So our objective on Monday is going to be to look for trades only in the bullish direction. Okay, now what we're going to do is head into the second layer, the contextual layer or the context layer, and within that layer we will build a proper market context on the 4-hour time frame. Okay, so now we will head down to the 4-hour time frame, and within this layer we will establish a proper market context. Okay, and then using that context we will frame our entries on the lower time frame, on the 15-minute time frame. Okay, now before I actually analyze this chart for you and we establish a proper market context, here is something really important. From the time the weekly candle opens right here, the Monday candle is open right here, till the London open, till that time we do nothing. Okay, we just let price play out, and we don't force any narratives and we don't force any market context. Okay, until that time, until the London open, we don't establish a market context. And only when we've reached the London open session and the London open session has begun, only then we begin monitoring the charts and we start looking for a dealing range and key levels and candle ranges. Okay, only then we start to establish, we start our process of establishing a proper market context. Okay, so first of all I'm going to skip ahead till the London open, and then we'll look at the charts and see how we can establish a market context. Okay, so right here, from this point on, we then have the 1 a.m. 4-hour candle, and within that candle we have the London open session. So I'm just going to keep it here right like this, and at this point from now on I'll now establish a market context. So now right here you can see that we've had a structure shift and a CSD. We had a change in the state of delivery after testing the discount key level. Okay, we tested the discount key level, the daily discount key level in the form of the order block right here. We reached the discount region of the macro dealing range. Okay, and after that we had a structure shift and a change in the state of delivery. Okay, now that we've had this CSD and that led to this new order block being formed, the first thing that I'm going to do here is first of all define a dealing range. Okay, so right here you can see that we've had this expansion swing. Okay, with this expansion swing we broke above this high and had a CSD. So what I'm going to do right now is take this expansion swing as my dealing range. Now within this dealing range, this is our premium region, this is our discount region. Okay, and within this discount region we've got this for our key level in the form of this order block. Okay, I'm going to mark out this candle as my discount order block, and this is where I expect price to potentially come down, react to it, and then expand off of here. Okay, and along with that we also have this candle just above the order block, which I'll take as my candle range or as my CRT. Okay, and this full structure, this dealing range that we have, this key level and the CRT, all of this becomes my market context for Monday. Now from this point on, once we've established the market context, we then move into the third layer, which is the execution layer. And within that layer, the first step is simple, which is to wait for your appropriate entry triggers. Meaning in this case, you will first of all wait for a liquidity purge below this candle range low and wait for a reaction off of this key level, or meaning wait for price to reach this key level. Those are your entry triggers in this case. And until that happens, you do nothing. Okay, the objective is simple, which is to wait for your appropriate entry triggers. And until that happens, you do nothing. And only after that happens, we start actively looking for our entry confirmation on the 15-minute time frame. Okay, now from this point, you've got three scenarios that could play out. The first scenario, which is the ideal scenario, is that we get our entry trigger in the form of a liquidity purge below this candle range low and a reaction off of this key level. Okay, and in that case, we will just drop down to the 15-minute time frame and we will begin watching for our entry confirmation, and we will validate our entry, and if that lines up, we will execute the trade and then we will ride this expansion higher. The second scenario is that we get our entry triggers and price purges below this low, reacts, hits this key level, reaches this key level, but instead of giving us an entry confirmation on the 15-minute time frame, price just dumps and pushes even lower. And in that case, you will avoid trading as a whole, because obviously price didn't give us any entry confirmation. So you would have been saved. And even though price dumped and pushed lower and went against your market context, didn't respect your market context, you would have been saved because we didn't got any entry confirmation. So you would have avoided trading. So that's the second scenario that we can get. The third scenario is that we get no entry triggers, meaning price expands without reaching this key level, without reaching the discount region of this dealing range. Okay, and this scenario, price just expands immediately off of here without purging the CRT, without reaching the key level, and basically we miss the move. And that scenario is completely okay too. Okay, and in that scenario, instead of forcing any trades right here, instead of chasing this move, you just wait and absolutely do nothing. You just let it go, because again, the objective is to follow your system, stick to your edge, follow your rules instead of chasing this move. Okay, those are the three scenarios that we can have. But in this case, right here, you can see, let me show you. You can see right here, in this case, right here, you can see that we've got the first scenario. We purged the CRT low, we reached the discount region of the dealing range, and we've reached the key level. We've tested the key level. Okay, we've got our two entry triggers. And now that we've got our entry triggers, we'll now go down to the 15-minute time frame. We will actively monitor the 15-minute time frame and look for our entry confirmation in the form of an order block being formed. And then we will validate and confirm that entry by confirming that it formed at a key time. Okay, now let's drop down to the 15-minute time frame and let's see exactly how I confirmed and validate my entry model in my entry setup. Okay, so first of all, you can see we got the liquidity purge below the candle range low right here, and we also tested the high time frame 4-hour discount key level in the form of this order block. Now I'm going to remove this line just so that it looks a bit cleaner here. Okay, you already know we've tested it, so there's no point in keeping it up there. Now, first of all, once we've gotten our entry triggers, this is where we move into the second step of the execution layer, which is the entry confirmation part. Now, you know that within the second step of the execution layer, we've got two key aspects or key elements. Number one, we've got timing, and number two, we've got the actual confirmation. Okay, now first of all, we will start with timing. So you can see we already got our entry triggers. We got the liquidity purge below the candle range low. We tested the key level. Okay. Now the first thing that we have to do is to validate whether these entry triggers happened at a key time or not. And right here, if we look at this time, okay, right here, if you look at this, you can see that you can clearly see that these entry triggers happened or formed or occurred, meaning we've got the liquidity purge and price reacted to the key level and tested the key level not only during the London open kill zone, which is a key time in itself, a key timing window in itself, but also these entry triggers happened at 3 a.m., which is a key macro, which adds even more probability to your trade or to your setup playing out and adds an even more stronger timing element to it. So right here, we've validated our entry. Okay, so timing is confirmed. We've ticked our first element or our first aspect within the entry confirmation part. The next thing is the actual confirmation itself. Okay, now that we've validated the entry triggers, okay, we validated that it formed at a key time, which is the 3 a.m. key time. The next step is to now wait for our actual entry confirmation, our actual entry model, our entry setup, and our entry pattern, and then place our orders around that entry model or around that entry setup. Okay, now at this point, there's two scenarios that could play out or that could happen. The first scenario is that instead of getting an entry confirmation, price just pushes lower, goes against your context, goes against your directional buys, and does not form an order block. And in this case, you do nothing. Wait a bit. In this scenario, you do nothing. Okay? You don't act like a dumbass and start justifying nonsense. Instead, you just accept the reality that you didn't got an entry confirmation. So in this case, in this scenario, you do nothing. You just let price play out and let it go wherever it wants to fucking go. Okay? And the second scenario that we can get is that we get an entry confirmation. Okay? If I let price play out a bit, let me do this. Okay? The second scenario is that we get our confirmation, which is that an order block gets formed. Okay, and even in that case, it's not going to be just as simple as that. We can get a lot more nuance than that. Okay, it gets a lot more interesting than that. Now let me explain what is the nuance that can appear or that can happen. Okay, it's really important, so pay close attention to this. Okay, don't skip through this part and listen closely to this. An order block isn't always a single candle. Okay, an order block sometime is a single candle, and sometimes, depending upon how price closes above candles, sometimes it could be a group of consecutive candles. Okay, an order block sometimes is just a single candle, and other times it's a cluster or a group of consecutive candles. And it all depends on how price closes above candles. Okay, let me break it down for you. So in this case, if price just closes above one candle like this one, then this candle becomes your order block. But if price closes above multiple candles like these multiple candles, these multiple consecutive candles, then all of these candles together become your single order block. And then in this case, you place your orders around this new order block. That's the logic here. Now let's apply that logic here. Now in our example, first right here, you can see that price closed above this one single candle. Okay, so what you do in this case is that you mark out your order block, mark out this candle as your order block. You place your entry here with your stop loss below the order block, and then you place your target. Okay, like a 3-hour target or maybe any other whatever targeting style that you may have. And then you wait. But then right here you can see that instead of testing this order block and then expanding higher, price doesn't come back to this origin, and instead it pushes higher and close above these consecutive candles as a whole. Now in this case, instead of incorrectly and stubbornly forcing price and expecting price to push lower and test this order block before expanding higher, instead of waiting for that scenario, what you would do is that you would logically adopt. Okay, in this scenario, if you had incorrectly forced or expected price to push lower and test this order block, then that would have been emotional, that would have been irrational, that would have been illogical. And instead, the logical thing in this scenario would have been that you would have taken this new order block, this new consecutive group of candles as your order block. And in this case, you would have put your entry order at the open of this newly formed order block with your stop loss below the order block. Or if you wanted to refine it more, then it would have been at the close of this order block. And then you would have placed your target, your order target, and then you would have let the trade play out. And that's how you would have stayed rational. That's how you would have adapted to the new price action, to the newly formed order block logically. And then right here, you can see the trade playing out. It worked out perfectly. And this is one of the trades that I had personally executed. And this was the exact thought process that I had.